The following presentation is brought to you as a courtesy from Forex Academy. This is part of our service, Become a Pro course. If you find it interesting and wish to be updated on new releases, please subscribe to our YouTube channel or join our community at forex.academy and receive all our services for free. Your like is also highly appreciated. Enjoy.
We can use total pip gain. A lot of traders like to use total pip gain. There's total pip accumulation, we like to call it as well. Focusing on total pip accumulation can help many traders with the emotional side of financial trading. Winning and losing is, of course, an emotional battle. For some more than others, I would say. One where we try to develop a level of complete objectivity to the market so that it doesn't hamper our overall adverse effects to trading performance. So does that make sense, guys? Can you see why that would benefit us? We don't want any sort of in and out or a monetary exposure or anything like that to have a psychological effect on our trading. We want to just get involved. And let's say someone was trading on a demo account for 2 months and was so successful at using his technical trading strategy on a demo account. Then when he was given 5,000 euros to trade, he just couldn't emulate the same performance, but he was using the same trading strategy. Perhaps he could look to not focus on the monetary aspect of how much money he wants to make, but total pip gains. Some traders might say, well, it is my target to develop 250 pips per week. I don't care how I do it in terms of my trading strategy. That's my target. I'll use fundamental analysis. I'll watch the news flow. I'll take some risks. I'll monetize those risks in terms of pip gains. But my target is to make 250 pip gains per week. Now, one serious advantage I would say to this strategy is that if you can do this on a consistent basis, all you need to do to be a very, very successful trader, a very rich trader, is to increase your trade size. Guys, if you can do this with 0.01 lots and you develop 250 pips per week on a consistent basis, you can do it with 0.2 lots. Then you can do it with 0.05 lots and moving on. So you just start to increase your trade size. That is the real advantage to this. Profit targeting with total pip accumulation centers on the objective of trading the markets and collecting as many pips across the markets as possible, thus leading to an overall level of consistent profitability. One downside to this target is that many markets across different asset classes have higher or lower pip values, i.e. cost per pip. So that is one thing you're going to have to take into account. Again, you might look to just use this strategy over the Forex markets, okay, because they're relatively similar, but you're very much aware that if you trade, a 1 lot or a 0.01 lot in an equity index, it will likely be much more expensive to compared to a Forex market, okay? So it's not the same across different markets. Your pip for value, so if you make 10 pips in, let's say you make 10 pips in the FTSE 100, that could be equivalent to maybe 10 euros. Where if you make 10 pips in euro dollar, that might be 10 cent. So it's completely different. So do bear that in mind. You're going to have to know and observe these across asset classes. So let's look at one trading portfolio here we have on screen. This is just one particular day that we can objectively just analyze for this trader, okay? Again, the question is always, guys, how can I profit? How can I profit trading these financial markets? Okay, so what we have here is 6 trades. We have 6 Forex markets, I think. Let me see. Yep, we have Euro Pound. We'll go through them together here. We have Euro Pound, daily price action. We have Canadian Yen, Dollar Chinese Yuan. We have Australian Dollar, Euro New Zealand, and Australian Japanese Yen. Okay, so great. 6 Forex markets to choose from there. How have we engineered some of these trades? Well, we have effectively looked to take both long and short positions in many different markets here. Okay, they look like good trades, and we'll see how they perform. Now, what has this trader done? First of all, can anyone just see as we look at any of these individual trades, what has the trader done? Susan says placed a stop loss for each individual trade. He or she absolutely has placed a stop loss for each individual trade when entering. So that's a very good observation. Yeah, always using risk management. Yes, absolutely. Sam as well was the answer I was looking for as well. Profit targets are in place on each particular trade. So this is more focused on what you would look to actually implement in terms of trading strategy, whilst focusing on total pip accumulation or total pip gain. You place the trade, your stop loss is in place, you believe the trade is going to move in that direction, and you place your profit target. So let's look across these markets here. What do we have on screen? Well, okay, so we have first of all a profit target of 30 pips. Then we have a profit target of 65 pips, 25 pips, 70 pips, 55 pips, and 65 pips. Okay, so that's absolutely the target here. He is trying to outperform the markets with no real pressure. He's just trying to deliver his pip gains. Okay, so how can he profit? Well, the overall profit target is defined for the day's trading at 310 pips. So it is a trading day. He or she wants to make 310 pips over these 6 trades. Now, it's more likely not going to happen that all of these are going to be winners, so that's fine. But he's getting involved in the markets, okay? Now, if he or she has decided to take on this approach, this trader, what has he effectively done? Well, he's placed his stop losses, which Susan said, of course. Stop losses in place, risking a total of 140 pips. So you can see this trader is looking to develop some sort of positive risk reward ratio over different trades. Okay, now effectively that is a very skillful trading strategy indeed. He is objective. He or she is objective. They're looking to outperform. They are probably away from their trading screen for some of the trading day and missing some of the action, but that's okay because their stop losses are in place. They believe that the markets are going to move in this direction and are going to profit. Okay, so effectively what is going to happen at the end of the trading day or maybe in the next 30 minutes, depending on volatility, at the end of the trading day, let's say, we're going to have a collective level of performance here. Now, if that is our trading strategy, we're able to quantify it as well. So we're able to say, well, if I do this each individual day, I'm looking for 310 pips just by picking trades, whether it's technically or fundamentally, or I'm reading price action. Again, some people just like to apply this to price action trading in its entirety, forgetting about everything else and just looking at the pip gain or pip accumulation over different markets. If you can outperform and do that, great guys, then you are going to make it as a successful trader. So let's move on then to discussing percentage trading, and this is very, very unique. This is very enjoyable. Again, these three I suppose developed methodologies in terms of profit targeting are so successful because if you get them right, guys, you can branch this over consistency over all your markets. If you follow monetary exposure versus risk reward, you're able to outperform the markets. If you can do that in 5 markets, you can do that in 10 markets. And again, if you can give yourself €30 stop losses on each trade and are doing that consistently, you can up your trade size, give yourself €60 stop losses, and obviously your profits will be bigger. Whereas it's the same to be said for the pip gains there. Once you can make all that pip gain profit on 1 lots or 0.01 lots, you can do it on 0.5 lots. Percentage trading is the same. So you can see what we're getting at here, guys. We are getting at developing how to develop your consistency as a trader. That is the question that every trader asks, specifically novice traders or beginner traders or ones that haven't developed profitable strategies that are showing them, consistent income for 3 months, 6 months, 1 year, 2 years, and beyond. This is the answer, guys. Developing this level of consistency to trading. Percentage trading is perhaps the most succinct and consistent methods of trading your capital across the financial markets. It develops a level of objectivity in trading strategy whilst allowing the trader to assume varied levels of risk within a structured framework of risk management. Wow, this is interesting indeed. Now, one thing I'd like to point out there, the most succinct and consistent method of trading over capital markets, okay, for financial markets. Why is that different perhaps to, let's say, pip gains or the monetary exposure? Well, like we suggested there in pip gains, each individual market is priced differently. So a forex pair is priced differently than the oil commodity. The oil commodity is priced differently than the coffee commodity. Then it's going to be to an equity, a single stock equity in the Nasdaq, and it's going to be priced differently than the German DAX per pip. So you have to do some sort of calculations to figure that out. Now you will have, because you're percentage trading, then you can actually look to just standardize your skills across all asset classes. Now there is some mathematics in that as well, but effectively you can look to take 1% trades across the board. Every single trade you take, you take will be a percentage of your account. So it's allowing you the ability to trade off your percentage of account within, and allowing you to assume varied levels of risk within a structured framework of risk management. Let's have a look at this in some detail. For example, the trader could choose to trade 1%, 2%, 3%, or even 5% of their capital on a particular trade. Now I have highlighted 5% there in red. Well, because it is, I would recommend, just a little too much to take on one particular trade. If everything stacks up, by all means, you want to take 5% on one trade, go ahead. But again, that would be the maximum, I would say, to take on one particular trade. Okay, effectively, if you have 4 to 5 losers in a row, of course, at 5%, you'll be diminishing sort of 25 to up and beyond 30% of your account. Okay, so it is still within structured framework management. That's why I want to keep that as a maximum, because there'll be no point to place 10 trades, 8 of which are at 1%, and the 9th is at 2%, and then you take a 10% trade on your last trade. Then you're not developing that level of objectivity in terms of a structured framework for risk management. In practice, the trader does have to compute how much trade size for each particular market he or she must take in relation to the percentage of risk assumed. A sincere benefit to this strategy is that it is fully quantifiable in performance. Isn't that great, guys? So if you are able to develop 4%, and we're going to go modest here, 4% of your account over a particular month trading the financial markets, and you can do that 3 months in a row. Well, that is gold. That is gold. That is absolute gold dust in terms of that level of consistency. Then you know that what you can do is increase your trade size. Perhaps, if you're taking all 1% trades, guys, take 1.5% trades, risk trades across all the markets. Start to think of the consistency, guys, because I would, if it was up to me, guys, and I was in your boots now, I would certainly forego 3 to 4 months of, potentially, higher gains, I would say, as opposed to sitting down trying to work out a trading strategy that is resolute, that is comfortable, that you feel comfortable with, that suits your style of trading, that then is starting in month 4 starts to deliver consistent returns, month 5 consistent returns. Then you can do that for the rest of your life, guys. That is what we're all about. That's what trading is about. So I really want to bring this education to you. So I really want to, help you through this process. So let's take a look at percentage trading. Okay, so what we have here is a market here. I've given just my account just to show you. We have a balance here of $6,535. Okay, you can see that just down at the bottom of the trading account. So how might we look to implement this trading? Well, therefore, a 1% risk trade allows the assumption of $65 to 35 cents to the downside. Okay, it's very simple, just 1% on the account. So in terms of my own account, guys, if I have, if you have $6,535 in your account, taking a 1% loser, taking a $65 loser is nothing really. It's not the end of the world. I would assume it's only one trade. Hopefully you've got other trades that are performing well. It's fine. You can see what I'm getting at. It's not really going to cause me any dissatisfaction. It's part of the game. And it's such a small relative base of my account. So that's effectively what I'll be looking to do. That's how I'll be looking to trade. But the more, if I can make 300 trades over the course of the month, all at 1%, and I can deliver perhaps a hit ratio of 60%, let's say. Well, there we have it. There we have, and obviously I'm able to take profit, more prevalently and revise trades, and that is going to be so important in terms of developing your strategy. It's going to effectively make my trading strategy definitively a profitable trading strategy over the long run. So let's look at this trade here. The market is strong during the trading day here. I've effectively entered the market. So I've entered the middle of the candle here. So I have foregone. I haven't bought the low, of course, very difficult to do. But we have a long entry with a 1% risk on account. The first thing I'm going to do is place my stop loss. I've chosen just hypothetically to put the stop loss there beneath the corrective low, albeit with a bit of space. Okay, so as the market moves up, it moves up initially, but it pulls back. It's moving up again, pulls back. I'll just re-annotate this. Well, you can see with the price action here, the guys that we have in front, just a bit of ambivalence here. It's quite difficult. It's just not, it comes back to break even, just comes back into negative portion. Now, what I could have done is mitigate risk at the top of this candle. If I really believed that the market should have traded up here, I could have brought my risk to here and I would be out of this trade a long time ago with a profitable exit. However, let's say I haven't done that. I'm still exposed on the trade. The market pulls back again, and then I'm just rolling over to the upside again. So here we're effectively at probably, I would say, a $10 to $15 point of profit right now. Okay, so I've been in this trade for quite some time, but I am assessing it. I'm looking at the candlesticks. We're trading euro pound. Okay, the euro is quite weak at the moment, but we know actually sterling is much weaker. Okay, so we see these series of higher lows, albeit this one just retraces. So that's maybe a signal to look to get out of this trade. But let's say we'll just assess the trade and we can now, manage this trade. That is the point of the revisibility of your definitive trading strategy, guys. You can't call a trading strategy successful unless you realize that, well, if markets move, you're able to react. So let's say, yeah, absolutely, we can now manage the open trade. So let's say the market's moving, and again, if it shows me, let's say instead of always talking about the negativity of markets, I'll give you an example. Let's say we trade this market here in front, and then as soon as I enter the market, we get this candle here. Then the next candle, it trades up to here. Okay, given there's a short-term burst in the market, but I know I was not expecting that, and these are long-term highs in this market here. I'll be quite honest with you, I am just going to take profit at that price. And most certainly, unless there's something really significant to tell me, maybe it's a fundamental shift or something. If it's well, that's besides the point. If it is something fundamental in the market, I'm going to go in search of that news, and I'm going to see, wow, I've made a great trade here. Is this the keeper? Is this one? Am I looking for, where are we now, 89s? Am I looking at 95s in this market in the next month? So the point being, guys, I am using my knowledge, I'm using the wisdom to look to revise this trade. If that is not the case, there's no fundamental news, we've seen a spike, I'm taking profit at that price. So it's revising the trade, it's looking to react, be more proactive with your trading account again, and that is going to help your consistency with your trading strategy. So what I want to finish off here is something which maybe some of you guys have never really heard about. It's the ability to really maximize returns, guys, and this is something quite advanced for us in terms of professional trading. Okay, now, guys, if you're able to do this, you will really outperform the markets, and that's every professional trader that makes it their sole income to trade the markets and really relies on their full income, in terms of trading these markets, does this. But the point I would like to make, guys, the key to this is risk management. It's always, always, always risk management. Okay, if you're looking to scale in, you're effectively adding much more risk. Now, I'm going to describe to you what scaling in means here, and we'll talk through it. Okay, Trader 1 believes the FTSE 100 market is strong. As such, he wants to get on the trend, but only wants to risk 50 euros. Okay, so let's say we're not privy to all of this price action here. We believe the trend is strong. We've hit lows there around the 21st of March. Okay, but he believes that there's going to be some strength coming into the FTSE, whether it's fundamental or technical analysis, let's see. But The point being, he only wants to risk 50 euros on this trade ever, okay? So he decides to trade with relatively small trade size and give himself some room. So he asks himself, well, how can I maximize profit on the trade? He trades his first trade here with the candlestick break to the upside, okay? Then he places a stop loss, okay? So his stop loss is 50 euro. That's absolutely fine. That's what he agreed on, first of all, and he has traded the market. Now, the market continues just to shift up. So the first thing I would like to suggest, guys, is, well, what should he do? As the market trades up to the upside, let me see. So we're entering this candle here. If the market trades up and up again here and here again, I would at least look to move my, well, at least when we're here and we get this pullback, I would move my stop loss up to the last corrective low once I see the market shift away. That's what I would do, okay? That is effective risk management. What was once an exposure of 50 euro is perhaps an exposure of, I'm going to say, plus 40 euro there, okay? Now that is just on the one particular trade. Now scaling in is the ability to maximize returns when things are working for you. Just think about logically what I said there, guys. You believe the market is going to move up in this particular example. Okay, you have your analysis intact. You've made a trade, which is great. You've backed yourself. You've placed a trade. The market then confirms that you were correct. I mean, what what do you want to do? Do you want to just take profit straight away? The market, it depends on the term of the trade, of course, when you suggested you were entering the trade, but too many traders do that, and I'll be quite frank again. Too many traders enter the trade, the market moves with them, they panic, they take profit. That's not how we trade the markets, guys. We look to effectively maximize profits if we can. If we think it's a trend, certainly we look to follow the trend. Now, what trader one does here, he's correct. The market moves up. He takes an additional entry with a trend confirmation long entry with a 0.06 lot. Okay, so he has taken two positions long in the market. Now, the point I would like to make when he does this, guys, when you buy a market again or sell a market again when you're trying to follow the direction, okay, effectively you're taking more risk. Now, it doesn't mean that your risk is just only that your risk has changed. It means that effectively your average price has changed. So again, I'll just take that off because that should be a 0.6. Again, right here, guys, we've taken a 0.6 lot and a 0.6 lot here. Our average price is right in the middle of this, so our average price is here, okay? So what we could look to do, guys, is effectively at that point in time what I said. If our average price is around the middle of this price action here, so our first entry 1, first entry 2, and again, we only wanted to risk 50 euros in the trade, we can do two things. We can move our stop loss up to around nominal levels, so this one's perhaps break even and this one's at 50% around here, or we can accumulate both trades and give ourselves a 50 euro stop loss at price. So it's roughly around, we could say the low of this candle is in around the break even, of course. But if we choose the low of this candle, say that's not break even, it could likely be well, it will be compounded to a certain extent, so let's say it's minus 20 there. So effectively we've mitigated risk, not totally, but what we allowed for our trade was 50 euros. Now we're only allowing a minus 20, okay? So effectively we've got less risk on the trade if the market pulls back, whilst at the same time, if it trades up, we're going to make much more money. Much more money. Does that make sense now? Now there is a real skill to this. You need to be careful with the risk management. Good practice to start to learn how to do this is to follow this practice here. We've taken a 0.06 and then another one. Our average price is in the middle. Simply take your risk management to break even. Okay, that's good practice just to learn how to do this first of all. Or of course, if you want to follow the first method of sticking to your 50 euro, you'll have to equate what that is. Let's follow this trade to the upside, like trader one here. The market trades to the upside. He's in great profit here. Absolutely fantastic profit. In and around these points here, he's in great profit. Now, there is a question that I would like to pose. I mean, is there a level of greed here? Is this trader just simply too greedy? Does he want more and more money? Well, yes and no. Yes, because he wants more money. But guys, that's why we trade the markets. You want to be you want to be able to take as much money out of these markets as possible. That's professional trading, guys. That's what we're doing it for. You know, we're in it to make money. So I'm going to say no to that answer. He has taken on assumed risk, a good level of assumed risk. Now, let's just say this is our first entry, this is our second and third entry. Then our average price is around the middle point here because they're all 0.06 lots, okay? Effectively have an average price. What we should look to do is bring our stop loss, guys, to our average price, because the last thing you want to do is to let this fantastic trade pull back for a loser. If it trades back down to here and your stop loss is still here, you're going to take a massive loser on this trade, inevitably a huge loser. That is not how you follow risk management for scaling in. You bring your stop loss up to around your average price here, okay? So effectively, if the market, although it looks likely at this stage to pull back, you're going to take a zero. And you'll be annoyed, guys, if that's the case. Of course you'll be annoyed, but you're trying to push the market to give you, you know, if the trend is forming, of course, and if the technical analysis is there and everything's stacking up, to make as much money as possible, guys. Now, effectively what happens here is the market trades up, and you could have taken profit, I mean, anywhere around here. I would say if you get that trade off and it trades up, I mean, when it gaps open here and shows you this signal here at the top of the market, I would say that is the place to take profit. Or you could simply look to move your stop loss up even further. Effectively, you'll be taking some profit in there. You could be taking, you know, 200 euros profit at that price. If you'll take a small loser on this trade pullback, but you'll take a whopper winner on this and a whopper winner on these two trades. Okay, so you're scaling in, you're allowing the market to confirm what it's doing, and again, you could take profit in and around anywhere. Now, this is day trading again, or sorry, this is looking at daily price action, guys. So there are ways to do this, trying to follow a move, and I want to show you just in the short term before we finish, because it's very, very exciting indeed. This is, I'll be quite honest, this is where I make, you know, most of my money in terms of large winners, in terms of the amount of risk that I initially take on. How can I maximize profit is the question. What we have here is per European economic data, guys. This is relatively recently. This is just there during the week, of course. We had flash manufacturing PMIs just coming in. It was the only positive figure there for France. Then we had French flash services PMI. Of course, France is a service accommodative country in terms of its economy. The expectation, guys, was 57.1. Can we see that? 57.1 on screen. What we see is some weakness. The realization was 54.3, so that's a huge miss. That's a huge miss here. And this is 56. So back to then with 8:30, we have German flash manufacturing. Bit of a miss there, quite a miss. And then quite a miss across flash services again. So huge figures again. The Eurozone in total, we had big miss across the board, huge misses. So very, very weak European data. How do we look to trade this? Okay, so the market opens lower at 8 a.m. After Asian session. Okay, so the Asian session just traded down quite strongly, so the market opens lower. So we just take a short position there, waiting to see this market trade down off the cash open. Okay, short entry at 0.04 lots. Then if we look towards our European economic data, we can spring on this here because the French data, now we're trading the German DAX at the moment, but obviously as a Eurozone equity market, it's going to be correlated, which we've learned, of course. Now we're trading the economic figure, something that we're already short from, guys. We're short, and we're not just looking to take profit. We're trying to react to the data, and it can often happen when you're in a position. You know, when new news comes to the market moves in your direction, and you're thinking, great, I can take profit now. Not always the best decision, guys. So how do we look to maximize profit on this trade? Well, we're short the market overnight. We're short the market just on the open there, and some news comes to the market again. The market moves quite strongly to the downside, so lower and poor economic data from the Eurozone and German data. We have another short entry, and look at the size of this candle. We have broke the new lows again, which I'd just like to point out. We are breaking these lows here, trading strongly to the downside. So we've taken another short entry on the German DAX. Again, not overcompensating with the risk. 0.04, just the same amount of risk, guys, to the downside. Again, what you might like to do in terms of scaling in is take your 0.04 trade For example, the second trade you might look to take a 0.02 just to try and accommodate and give yourself a better average price, perhaps a little higher. It's down to yourself, guys, but that's how to effectively look to scale in. Now, the market moves down, we have a really strong engulfing bearish candle. Everything looks good, so we're holding this to the downside to see what happens. Of course, our risk management should always be intact, and the market opens lower the next day. So we actually take another short entry, and this time we just take a little less risk, so 0.03. Our average price is going to be quite high indeed, given we're short. It'll be probably around here, these levels here above our corrective highs, so that looks like a fantastic trade, and the market trades to the downside, guys. Effectively, we can exit here for an absolutely fantastic winner. So if this is something that I have traded recently, to say I'm going to give myself a 100 euro stop loss in this, effectively I've made something in the region of 600-700 euros on this one trade. Always managing the risk to the downside. If it pulls back, you're going to say, why didn't I take that 100 euros when it was 200 euros profit on side? Now I've got nothing. But if you do this 10 times out of 10, guys, you will make one or two of these trades, of course, will pull back. Some of them you'll take earlier winners on, but one of them or two of them, guys, you will make a substantial winner on. And this is often how actually, I know we discussed averaging in some earlier education. This is how retail traders or novice traders actually blow up their account. They do the opposite of scaling in. They average in, where they buy a market, the market moves down, they buy it again, they don't want to take the loser, the market moves again, they don't want to take the loser, the market moves down again, they end up losing their total capital on account. Effectively, you can change that equation around and maximize profit here across asset classes. It is a skill. Do focus on risk management and entry, but do practice it on the demo account as well if you want to have some practice before enabling it into your trading strategy. Okay, so very interesting indeed, guys. That brings us to the end, unfortunately, of this lesson here with our lesson summary. A profitable trading strategy takes time to develop and must be suitable to the individual trader. Trading strategy is not only about how you choose to enter and exit the markets, but how you define your profit expectations and targets. And the cornerstone of any profitable trading strategy is discipline, patience, and consistency. And that's it, guys. That's what I want to leave you with this Become a Pro course. Discipline, patience, consistency. I know I'm reiterating this in some lessons, but guys, if you can understand this and take this on board and master these skills and develop them into your own trading strategies with your profit targets, guys, you're fostering the right attitude to develop a profitable trading attitude consistent over the next 3 months, 6 months, 2 years, 5 years and beyond. That's what I want the students to come onto these lessons for and enjoy them and teach them, educate them, teach them how to trade. Do I think everyone should be trading the price of oil, given its global commodity and it moves all the time, and profiting? I absolutely do. So get involved in trading these markets. Get the education in. Absorb it. Start to develop yourself as a trader. Practice it. Look at your performance with that strategy. Develop your objectivity to your trading, and you will be on your way to professional trading. So that's it, guys. I really enjoyed today's lesson. What I'd like to, just as an interlude, just to deliver here, we have some bonus webinars here as we finish the Become a Pro course. These are now going to be implemented into your members login area for revision, so look forward to them. They're going to be quite detailed as well. Number one, the quantitative robustness evaluation of a trading system. And that's going to talk through Thorpe's approach, Van K. Thorpe's approach with mathematical expectation of a system. So we talked a little about expectation today. Mean and standard deviations of distributions. Again, we're talking about statistical inference there with technical analysis, mathematical forecasts of performance, objective calibrations of risk as well. All of these undertones are enveloped there in a lot of education. We went through the Become a Pro course for the last 16 lessons, so that's fantastic. And again, I want to leave you with bonus webinar number 2, a review of popular ways to trade, just to get you thinking about how to start to build all this in together. Scalping, that might suit you. Taking very small levels of risk whilst entering the markets numerous occasions per day, or perhaps off hourly candlesticks and all these things. So scalping, harmonic and fractals, swing trading, tramline approaches, so different approaches there, popular ways to trade. Okay, so you will enjoy those bonus webinars now being uploaded into your members login area. So fantastic, guys. Look, congratulations. We have now finished, well, webinar 16, and also the entirety of the Become a Pro course. Has been a very, very enjoyable experience with me here. I know I've got to know quite a few of you over the last month with the Become a Pro course, and you have been visiting more of our education. I've seen Michael and Susan there on the European briefing this morning. That was great. And some of you guys were during the Active Traders Live education as well. So hopefully you're actively getting involved trading the markets. So what I would advise you guys is just, you have it there in your members login area as a full member of Forex Academy. Revise it, go over the lessons, you know, go over sector analysis if you're considering becoming more of an equity trader. Go over market correlations if you want to play some spread trades. You know, go over some supply and demand functional webinars that we had there. Of course, if you want to only trade commodity markets, it's all designed to give you an overall perspective of trading all of these asset classes. And of course, you don't go over this lesson today, particularly if you're looking to develop your approach to successful trading, so that you can say, well, I have a plan. It's a 3-month plan. By the end of 3 months, I want to be trading 12 weeks. I want to assess how I've performed over those 12 weeks, and hopefully it will lead me onto a path of successful trading. That is a very, very that's a fantastic goal for any individual trader to come on and follow through on that. So guys, I really thank you very much for all the positive feedback, and I do hope to see you during some of the technical education that we have and produce at Forex Academy, and hopefully on some of the active trading courses, as well as Institutional Trader Live as well, which is quite enjoyable for long-term positions across different asset classes as well. So look, all that's left for me to do then, guys, is thank you so much for joining us here at Forex Academy. It's been an absolute pleasure. We'll see you next time. Bye for now.